Welcome, everyone, to the Information's TITV. My name is Akash Basricha. It is July 23rd. Today on the show, we are talking to the CEO of AI video company Runway about the company's enterprise sales approach. We are also talking to Tomas Tungus about the most interesting metrics that he has to assess AI startups. That always promises to be a data-heavy discussion. I'm excited for that one. And finally, we're going to end by talking to our cloud reporter about Crusoe, a data center company that is now making a much bigger play at competing with major cloud providers. That was a story that was published in the Information this morning. Very excited for that conversation. Before we get started, I want to go through a couple headlines that are making news this morning. Alibaba has launched an open source AI coding model. They are basically going after Anthropic with this play. We, of course, know that tons of companies in China, including ByteDance, are working on AI coding models. And so you can add yet another company to the list. Here's an interesting story. Amazon bought Bee, an AI hardware startup that the company sells a $50 wristband. It's kind of like a Fitbit. The only thing is that it transcribes your conversations, because who doesn't want their trip to Starbucks on paper transcribed? I was looking at this headline and I couldn't help but recall Amazon's last play into wearables with its Halo Fitbit-like wristband. That obviously didn't go the way they wanted. They pulled out a couple years ago, but we are giving them all of our best wishes for this new play. AI wearables is certainly the thing to be in on these days. Last but not least, I want to go through some earnings that we've got tonight. Google and Tesla. I asked our Google reporter, Erin Wu, what she's watching for on Google tonight. She told me she is looking to see if chatbot competition eats into Google's search revenue. We, of course, know that search revenue slowed in the last quarter. And as it relates to Tesla, I asked our electric vehicles reporter, Steve Levine, what he's looking for. He told me two things. Number one, any update on removing safety drivers from the robotaxis that are roaming around Austin. And number two, he's also looking at the extent to which lower prices and lower deliveries are hitting the company's bottom line. Okay, let's get to our first guest. AI video has been all the rave lately, and few companies have been as central to that conversation as Runway. The company was last valued at $3 billion, and I want to bring on their co-founder and CEO, Cris Valenzuela, to talk about this moment for the company. Cris, thank you so much for being here, and welcome to TITV.
Yeah, of course. Thank you for having me.
So I want to talk about your company's enterprise sales and product strategy. I mean, help us understand what products you have that are targeted towards the enterprise, and then also how you're pitching them to businesses.
Sure. We work a lot with different kinds of enterprises, which is kind of interesting because you might think of Runway as a company that's mostly working with media, with Hollywood, with videos, which is true. But the thing is that many of the underlying capabilities and features of the models themselves are also very useful and applicable in like wide domains of industries. Like we sell a lot to architects. We work with brands and with the e-commerce sites. And really our enterprise solutions are not too different from like what consumers or consumers can access, which is, I would say, the beauty about good generalizable models is that the use cases are broad. And so if you have enough of a good set of references, for example, that you can provide the model, then you can use them in a wide set of spectrums and kind of objectives. And so we're selling right now to a lot of studios, media companies, and the offerings are, just the best product. It's the best way of creating media, creating pixels, creating images, creating videos in a way that's secure, in a way that's fast, in a way that's reliable. We have a way of managing credits and managing like subscriptions for your accounts and your teams, things that companies really care about, and all, of course, in a very like safe environment as well. So I think it's a combination of different things that starts with a really good product and then happens kind of like across the board solve for hopefully every single task that they have when it comes to media creation.
So when you break down the company's revenue right now, how much of it is coming from enterprises and how much of it is consumers?
We see a growing trend from enterprises. I think it's a good sign because it tells and it means that companies are more ready than ever before. Look, selling to Hollywood 2-3 years ago was very tough, was very hard. People had a lot of concerns, like considerations, and there was a lack of understanding what the models did, and how they could be useful. Now these days, I think like everyone is on board, and so selling to them is way more easier. There's a better understanding, and a lot of our growth, it's coming from those kind of like inflection points. We've seen that
Are we
in
talking like 10% of revenue, 20%, 50%? I mean, how much is coming from enterprises right now?
it's growing a lot. It's we don't disclose numbers specifically, but it's a growing kind of like part of the business when it comes to growth. Like this is where we're spending perhaps most of our time these days.
Right.
Because the demand is there. People want to use it. Like we get way more like influx of requests that we can handle at any given point. And a lot of it has to do with like helping people on board. People can just buy and serve themselves with an enterprise plan, but we have the special like offering. We have this we've been working on this idea for quite a long time where we deploy creatives inside the companies. And so you can think about it as kind of like what Palantir does with like forward deploy engineers. We do like forward deploy technical artists.
Oh,
So we
wow.
have artists that go inside your studio, your company, your advertising like agency, whatever form or function you have, and we help you drive adoption within the company itself. And the reason for that is most of what you can do with Runway is non-traditional. It kind of breaks the mold on how you've done content before. And so if your whole company has been working with Adobe software for 20 years,
Right.
you can do the same thing for a fraction of the time and cost with Runway. We just need to switch your mental models for the first time. You need to understand this different way of working. And so we get people on board, we deploy them into those companies, and that helps drive adoption like significantly.
So these are like your own Runway consultants inside your enterprise companies, helping, showing them how to use the tool,
Correct.
essentially.
Correct. Yeah. And helping them like transition. I think for all of these companies, this is a transformation. I think the metaphor, the equivalent I've heard a lot of times inside these companies themselves is like this feels like the cloud transition, where you had to realize that the cloud was how you're going to do business like 10, 20 years ago.
Do you charge them more for that?
Yeah, there's a premium that we charge. We're deploying our employees to like your company, so you get to work with them directly, and also with the rest of the team. And I think that the value there is that once you get there, we have like case studies or companies who start with like 20, 40 licenses, and now they've grown to like 1,000 licenses or so. And I think part of it is just you start understanding more the workflow, you start understanding more the use case, you fine tune your models for that, you keep it improving, and it's then it's like an obvious like trade-off.
Talk to me about, as it relates to what has been interesting for enterprises. I mean, are these mostly enterprise subscriptions? Is it access to the API? Where is your focus right now?
It's a combination of both. On the API side, we produced a couple of new models. Most recently, we did Act 2, which is this state-of-the-art performance motion capture model that has been incredibly well received. It's one of our best products. We have the API for that. So there's a lot of use cases around like custom workflows that people have, specifically within high production and media and advertising that people are leveraging Runway and Act 2 for. We have references. So references is an interesting product because references allows you to kind of customize or edit an existing image. And so let's say you're an e-commerce site. We're selling to brands. So we just signed a couple of like some of the biggest like luxury brands. And the way they could use it is you can take an asset that's either in your website or it's part of a campaign, and you can iterate and edit it and modify it either for a specific customer need. So you go into like one of these websites, one of these companies, e-commerce sites, and you can put yourself in the clothes or the brands or the things you're buying just by hitting the API once. Or you can think about like a major e-commerce site that has millions of assets, and they want to either remake some of those visuals so they're more compelling. You can use the API for that. And so you have this programmatic, like massive at scale editing and generation of content that people are using Runway for. And then for more like professional and specific and campaign specific kind of workflows or movies or short films or ads, people pay for the subscription. So you pay for Runway, you subscribe, you get the credits, and you use it within the interface. You have this team account, so you can show your assets to other people. You have a manager. You have all the things that professional like enterprise software like needs these days. So yeah, it depends on the need, and I think we're solving for both.
You guys have gotten a lot of traction in Hollywood with your product. You're one of the few companies that Hollywood is actually really eager to work with. Are you working with Netflix?
We're working with a wide spectrum of like studios and companies. I think these days it's safe to assume that many of them are already like exploring AI or using AI. We don't disclose our customers like publicly, but it's safe to assume that I would say every single studio there and every single media company has and needs, and it's already aware that AI is perhaps the most important technology of a lifetime. I'm not exaggerating. This is things they have said publicly as well.
Hmm.
And the reason for that is that content decreases, the cost of content decreases, the volume of content increases, and
Right.
if you're in the business of media, that changes dramatically the way you're doing business, and so you need to be aware of it. And then look, I think media companies and Hollywood studios and streaming companies and production companies have been thinking about this for quite some time. I think most of them already like fully on board on what AI means.
Hmm.
And I think now we're transitioning to other industries. Now gaming companies are becoming very aware of it and like understanding the affordances of what it means. And so we want to make sure we can also help and serve them as well.
Hmm. I want to shift a bit to talk about sort of the cloud provider angle to AI. I mean, video is a very compute intensive operation. You guys work with Microsoft and Amazon, am I right, as it relates to cloud providers?
We publicly have relationships with AWS and GCP.
And tell me about just, how do you think about the big three insofar as, who's good for what, and how do you sort of delineate between them?
I mean, they're all good in their own way. I think it depends on what you're building. I think some companies might like us that are mostly doing core research and frontier research. You just want to have access to the best
Hmm.
infrastructure to do like research at scale, and so you want to partner with someone who can give you good prices, someone that can help you debug. There's a lot of like new and upcoming challenges on managing the size of the infrastructure that this companies are building. I don't think there's one or others that are better. I think they're different things. And so
Right.
most people tend to have different like multi-cloud provider options just so you can switch as you go.
I mean, if we zoom out a bit, I wanted to ask about compute a little more broadly. I mean, if you take sort of, your company's sort of demand for compute over the past year, talk to me about how that's changed over the past year.
It's increased. I think that's expectation. And it will continue to increase. I think that's a reality of both training models at scale and inference as well.
But
I mean,
have
we
you
have
been able to lower your cost of compute at all?
yeah, of course. I mean, so I don't think there's those two things go hand like together. I think you're able to lower the cost mostly because you're able to optimize the deployment of the models in inference workloads. And also chips become cheaper. Like innovation keeps on happening. And so you benefit from the overall macro of where the industry is heading. And you should expect inference and training costs to continue to go down. Now, that's happening at the same time that you need to spend more time and more resources to train larger, bigger models. And so you spend more on compute. And so you can see both things happening at the same time, perhaps at different ratios, because like better chips and better GPUs are also constrained with logistics and just like physical, the atoms are always harder. But if there's something that engineers really love is optimizing. And so if you have a model, distilling it and finding ways of optimizing it so it's cheaper to run is something I think every company is working on these days.
Hmm. When you think about technical challenges that Runway is facing as you continue to develop your products, what is the biggest technical challenge that your team is grappling with right now?
Um, well, there are a few. I mean, from the one end, making sure these models are really controllable for the experiences that we want for our customers to have remains a big challenge, and that's what we've done and we saw with references. References is an image and video model that allows you to manipulate pixels in ways you couldn't do before, and a lot of it has to do with the insight that we get from our customers on what they really want. And so a challenge is how do you train models to do that? There's another challenge on like speed. So how do you make those models fast, really reliable, really like with the feedback loop in creation becomes like instantaneous. And I think that comes with like a set of engineering research problems as well. And a lot of it has also to do with helping people transition from this very obsolete, outdated workflows they've been relying for many years to a completely different way of making things. And that also has just a market challenge as well. You need to help people understand kind of how this works. And I think we're working on all of them. I think we have a very unique perspective. We've been working on Runway for quite some years now, like almost 7 years. And so we've gotten a lot of experience, I would say, and intuition on what works. And I think one of the things that is perhaps underestimated these days in research, people think about compute and data and like talent, but I think intuition and taste and direction of where you want to go, you could technically go anywhere research wise. Picking the right vertical becomes or the right direction becomes incredibly powerful. And you can see some companies, like major big companies, who've chosen the wrong path, and it's cost them a lot. And so intuition for us has become critical in the way of solving some of those challenges.
I want to pick up on that. I mean, one of the things that we've reported on at the information is, we know that Meta is beefing up their research team. That's the approach that they've taken. We also wrote a story this week about how Apple, a lot of the power at Apple with respect to AI now sits with the product team, and that's been sort of a source of tension at that company. I mean, as it relates to research versus product, I mean, how do you think about that at Runway? Do you think about it as yourself as a product first company or research first?
Yeah, it's a great question. I actually wrote about this a couple of days ago, and just to go like a bit more in depth into my thoughts about this. But my summary and my realization over time is that these days there's no distinction between the two. I think it used to be the case that diffusion of technology was slower. You had research, R&D, you have innovation, and that took like years to like diffuse itself to customers and everyone who could like access it. And within that transition period, you change the research, you improve the product, you get feedback, and it was years like to make. These days, for a combination of different factors, including like just much better distribution networks, social media, like AI being so like valuable for like so quickly, the diffusion of technology from like a core research model, something the R&D team has been working on, to like a product is like that. It's instantaneous. Like it just literally is one line of code that you can just have.
So I know you don't see any, you sort of see them as the same, but don't researchers want to just focus on research? I mean, isn't
well, I think that's true. I mean, researchers might want to just focus. Some researchers might want to focus just on research, and if you're a research organization and who's not thinking about product, that's fine. Like you could do that, and I think that part of the companies you were mentioning perhaps were too much focused on that and missed the train or understanding that you need to be able to deploy these things in real case scenarios. You need to be able to learn really quickly. If you don't, you're going to be left behind. And look, you can have great research papers, you can have new methods, all great. But like at the end of the day, if you're focusing on building a business, you need to build stuff that people care about. And so my realization is the best, and this comes back to sometimes like perhaps hiring and who you hire. But in my experience, the best people are the ones who are researchers who understand the product feedback loop.
Right.
If you're just focused on research for the sake of research, that's great. But in this world, on product world, that might actually backfire in the long term.
Right. Last question before I let you go. There were reports last month that Meta was talking to you about a potential acquisition. Is that true?
I can't really speak about that. You know this.
All right. Well, thank you so much, Chris, for coming on the show. We really appreciate it. It really is fascinating to hear your perspective on research versus product. And we'll have you on the show the next time we hear that Runway is used in a feature film. I'm excited about that.
Awesome. Thank you. It was good chatting.
That was Chris Valenzuela from Runway. Our next guest is one of the most data-savvy venture capitalists that I've ever spoken to. Tomas Tungus is a general partner at Theory Ventures. The company's most recent fund is focused on investing in 3 categories: data, AI, and decentralization. He also has a great newsletter that goes out every night, and he wrote a great opinion piece for The Information a little while ago. We will link it in the show notes. Tomas, thank you so much for being with us. We're so excited to have you here on TITV.
Oh, thrilled to be here. Thanks for welcoming me on. I appreciate it.
So look, you're a numbers guy. We talk about numbers a lot together. I'm curious, what metric have you been fixated on in 2025 as it relates to assessing AI startups?
Net dollar retention.
Same as usual.
Yeah, well, I think it's ultimately the core health of a business, and we're in this market where you see these astronomical growth rates of pretty phenomenal companies, and we have very little longitudinal data on ultimate retention. And ultimately, margin structure and net dollar retention are what make company and growth, obviously, but what make companies valuable in the long term. And we don't have a lot of that data yet.
Tell me a little bit about the ways that you see startups putting lipstick on their numbers as it relates to revenue and ARR and annualized revenue. Walk us through what you see.
Right. Well, I mean, I think the first thing that you see is you see transactional revenue or consumption revenue that's annualized. And Snowflake does this in the public markets. Twilio has done it for a long time. It's very reasonable to do at large scale, right? If you're a publicly traded company and you have 4 or 5 or 6 or 7 years of usage data, you can create forward models with linear, even basically linear regressions that get you to a place you can be confident that you can annualize a number. But if you're a company that's 9 months old, much harder to do. We still call it ARR. We accept it as an industry that it's annual recurring revenue, even though it's transactional usage based. The second dynamic that we see is 12-month contracts with 3 months opt-outs. So I signed the information. I started an AI company. Gosh, I sell you some fancy piece of software,
Right.
and you have 90 days to opt out.
Huh.
Startups are annualizing those first 3 months and saying this is our ARR without any conversion information or any conversion information at large scale. And so there again, if you're big and you have a lot of historical data, it's fair to annualize. A more conservative view might be it's a bit aggressive. Yeah, and then the very last is monthly net dollar retention or monthly expansion. We really need to look at those numbers on an annual basis. So all of these things are kind of borne out or the byproduct of just very high growth companies, growth rates that we haven't seen before, trying to fit metrics that worked in a previous generation.
I'm curious, how much do you look at, the AI companies now? You've got teams of just, 1, 2, 3 dozen employees that are posting, huge top line profiles with very slim teams. I mean, there is a question about how sustainable the company will be, whether they don't have headcount to support that. I mean, do you look at any numbers there with respect to like, this is still a small team, we got to be careful here.
Yeah, I mean, I think ARR or annual recurring revenue per employee was a metric we've been tracking. I've been tracking for a long time, and startups kind of start around like 50 to 60,000, and then publicly traded companies in the previous regime were around 150 to 250K, topping out at maybe like 400. And now we're starting to see startups with 1, 2, 3, 4, 5, 10 million of ARR per employee. It's pretty sensational. I will make a distinction here, which is the companies with the highest ratios tend to be product-led growth. They tend to be companies that are adopted by individuals, grow through word of mouth. There's not a significant, say, enterprise business yet. And I think as the companies grow, the importance of customer success, onboarding, solution architects, all those kinds of enterprise relationship management functions will become more important.
And I mean, to that end, you actually wrote a blog post about how Figma, coming up in the public market soon, they are an example from your view of product-led growth and just how sensational that could be.
It's phenomenal. I mean, they have a sales efficiency of 1. A sales efficiency is how many dollars of sales and marketing investment do I need to invest to produce $1 of gross profit in the subsequent period. And I think there's only one company that's ever come close, which is Shopify. And we can debate whether or not that's a pure software company because there's a huge amount of transactional revenue there. But it just tells you how efficient that business is and why I think it'll trade really nice. This is not investment advice, but I think it'll trade really well in the public markets because it's an incredibly efficient, high growth business.
I was listening to a podcast that you did earlier this week. You were talking about building your firm as an investing corporation. And, sounds like an investment firm to me, but I think you have a very specific view on what an investing corporation is. So, I mean, walk us through your methodology there. What do you mean by that?
Yeah, so venture capital started as a little industry with 6 or 7 people around a lunch table on Tuesdays. And gosh, if you and I were in that 7, we'd get together Tuesdays and I'd say, I found this investment opportunity. I'm willing to invest 100,000. The round is $1 million. Everybody else would write a check. And that's how the venture capital industry started.
Right.
And then that lunch group formalized itself into a partnership. And we've been running with that model for a very long time. I think now we're starting to see the evolution of venture firms where they are financial companies, right? They look like a Fidelity or a T. Rowe. They look like the hedge funds that are like a Bridgewater or Citadel, where they're corporations, right? There's a CEO, there's somebody who's running the firm every day. They think about the product that they sell. There's sales and marketing, all the classic departments. There's R&D, there's AI. And so that's a pretty fundamental shift, right? If I think about when I started in the industry, most of the firms, it was a group of investing partners and some associates and some principals, and then a finance team. and some support staff. And that's the way that, but if you look at the industry now, it's radically different. We have platforms, we have all these different functions. And so they end up looking like companies. We sell financial products at the end of the day, and we do it to two different markets, first to startups and then to our investors, our LPs. And that formalization parallels what's happened in the private equity industry and the hedge fund industry, and it's coming for venture.
Right. I mean, I can certainly see how having all that support from a startup's perspective is great. You get a VC that invests in you, you've got all the support around you. Is there a downside to this shift at all?
I don't think so. I don't think so. I mean, it's a different structure, but the specialization of labor really helped. We hired this phenomenal head of AI who has started to build out some pretty significant internal systems, and the pace of innovation has just been really, I mean, exceeded my expectations. And I'll spin up Claude Code. I built some of our initial systems, but I was just doing it on the side. And now to have a dedicated team doing that, it's fundamentally changed. We have a wonderful go-to-market leader who builds the sales teams and helps build the sales teams for our companies. And having somebody focused in each of those roles with OKRs, goals. The OKRs is the goal planning system
Right.
that I learned at Google. It really just it creates a level of operational discipline and rigor that is found within operations, but is just coming to venture. Just starting to come.
But before we go, the last topic that I want to get into with you is the idea of tokenization of stocks. It's kind of a fascinating topic. You've spoken a little bit about it. Look, I want to ask you, fundamentally what the point is here of tokenization of stocks. I mean, I see some of the benefits here, the fact you can trade 24/7, but what problem is this really solving?
Okay, so I think there are two problems. The first problem that they're solving, and you can see this with the dynamic between Robinhood and OpenAI, when Robinhood created a derivative on an SPV, a special purpose vehicle, to invest in OpenAI, and they have a derivative that replicates
Right.
OpenAI's share price, right? So what problem is that solving? Well, the number of publicly traded companies in the US has fallen by 50% in the last 20 years, and that's because the cost to go public is 15 to 25 million.
Right.
And so if you're generating 100 million, you're not going to spend 15 to 25% of your revenue on a financing round. It'd be silly. You could raise a round in the private markets for less than $1 million. And so there's a cost barrier to going public. As a result, the universe of privately held venture or startups is now enormous, right? We're talking.
Before you get into the second reason, I mean, does a company that small really need to go public?
No, the reason you used to go public is because the only way that you could raise 50 million or 100
Right.
million was in the public markets. And now the private markets have become gargantuan, right? Venture's gone from 8 to 250 billion a year. And that's just looking at early stage venture, not to put crossovers and those kinds of investment vehicles. So the private market, as a result of increasing costs to go public, and those costs are the financial costs that we just talked about, but then the onus of quarterly reportings and the challenges of speaking publicly, candidly, being aggressive in acquisitions. Look at the dynamics and the way that Databricks can be very aggressive on acquisitions, and Snowflake, it has to be a bit more conservative because they have to justify acquisition multiples, like in the case of Tabular. So you're a bit more hamstrung when you're public. So if you can raise just as much money in the private markets, why wouldn't you?
Right. And then so I guess it brings me back to this. So why tokenization of stocks?
Well, so how do you grant access to retail or large institutional buyers to private stocks? Well, you do it through tokenization. Yeah.
Right. And I mean, I guess so. I see it from the giving access to the public markets for private companies, without going public. I see that. But I mean, as it relates to sort of,
why use the blockchain?
Yeah. Well, yeah. I mean, the stock market seems to work just fine, no?
The stock market does work just fine. There are just lots of regulations. So it's not a technical reason. It's a regulatory reason. And so,
right.
So the reason to use a blockchain, all of a sudden you can access global financial markets as opposed to just the people who can do business in the venues in the United States. That's one. And then two, Robinhood can just launch one of these tokens. They don't have to file an S1. They don't have to go. I mean, there's limited regulation here, but compared to Sarbanes-Oxley or all of the SEC regulations around like the Investment Act of 1933 governing securities, there's a regulatory arbitrage. And so as a result, there's, maybe put it a different way, it's a novel financial product that allows commodity brokerages to differentiate very quickly. And because they can move really fast and capture this zeitgeist that there's a lot of retail demand for AI in private markets, there's this nice confluence between the buy side and the sell side. I mean, you look, I think the most fascinating part of the IPO market in 2025 is the two hottest stocks. Neither one is software. One is a cryptocurrency, a stable coin, right? And it's traded to the moon. Yeah. And then the other one is basically a REIT.
CoreWeave.
It's a real estate investment trust that builds data centers. Neither one of those is a classic software company. Figma will be the first software company. And so what that tells me is if there's so much demand for exposure to stables and AI that people are willing to take these, trade these to the moon, then that means, there will be a lot of demand for synthetics or derivatives into these late stage companies. And then you look at the scale of the secondary purchases or the oversubscription in the SPVs going into SpaceX and other companies, you can see the demand is there. Plus the Trump administration signed legislation last week that allows 401ks and retirement assets now to be deployed into private vehicles. There's a tsunami of retail demand that's coming for these assets. And so the tokenization allows these brokerages to capture some of that.
Well, it's a very fascinating topic. It's one that we hope to cover more and more on this show. Tomas, thank you so much for coming on the show. We really appreciate it. Once again, that is Tomas Tungus from Theory Ventures. Now, this morning, we published a very interesting story about Crusoe, the data center company that has inserted itself into the conversation with the likes of OpenAI, Oracle, and the White House. We reported today that Crusoe is looking to raise around $1 billion and is making a much bigger play at competing with major cloud providers. I want to bring on Anissa Gardizy, who was one of the reporters on that story, to talk about Crusoe. She's been covering the company for a long time. Anissa, this is your second time in 2 days. Welcome back to TITV.
Crazy. Thank you, Akash.
It is an exciting time in cloud and chips and energy. Look, Crusoe is kind of a fascinating company. I covered the company, but when I was a crypto reporter here at The Information about 3 years ago. And at that time, they were focusing on flaring and on Bitcoin mining. I mean, the company has come a long way since then. How has Crusoe traditionally made its money, as it relates to its AI operations?
Up until March of this year, a lot of its money still came from that legacy crypto mining unit that the company had. Earlier this year, it sold that business. And so now it's pivoting and hoping that more of its revenue can come from its cloud business, which is renting AI chips to customers.
Renting AI chips to customers. So why? Well, I mean, why is it hoping for this? Help me understand the opportunity here.
Yeah, sure. So the company realized a couple years ago, like many others, including CoreWeave, that if they could energize data centers quickly and then put GPUs in those data centers, AI customers like OpenAI, Microsoft would pay a lot more for that compute than the Bitcoin industry and potentially be more stable. So that is why the company decided a few years ago to pivot from Bitcoin to cloud. And we're kind of just starting to see that growth in terms of revenue now.
You and I talked about Stargate yesterday on the show. Help me understand Crusoe's role in Stargate.
Yes. So in Stargate, which is in Abilene, Texas, Crusoe is not acting as a cloud provider, which some people might think that they are, but Oracle is the cloud provider and OpenAI rents chips from Oracle. What Crusoe's doing is it secured the land, secured the power, worked on the development of the data center, getting it done in record time. And the revenue that they're earning there is mainly construction management fees. And then when the project is done, they can sell their stake and make money that way through the real estate asset. So that's their role in Abilene, but they're hoping that in future projects, they are able to make that cloud revenue that, in this case, Oracle would be making.
So they want to be the Oracle. That's quite interesting. I will also say we had a great weekend story about Crusoe. One of our reporters went down to Abilene and met with the team. We will link it in the show notes. This is kind of an interesting shift to cloud that Crusoe is embarking on, you had some reporting about their ambitions for this division of the company, how big they expect it to get. Walk us through some of the numbers that you found.
The numbers are pretty shocking. So last year the cloud business did 100 million in revenue.
Okay.
And for context, last year
the whole company or just the cloud?
Just the cloud business.
Oh, it's just the cloud business. Okay.
Yeah, because they still had Bitcoin last year.
Right.
And to put that in context, last year CoreWeave was at around 2 billion. So Crusoe last year was at 100 million, and they are projecting that in 2026 they cross 1 billion in revenue of the cloud business, and then in 2030 they're projecting 18 billion. So it's very rapid growth that they are projecting to investors.
So 1 billion in 2026, and then 18 billion by 2030, just for the cloud business.
Yes, purely from renting AI servers to customers.
Okay, that's a big number. So put that into context for us. How big is 18 billion?
Yeah, I mean, obviously it's a big number. Maybe it would help to know that like Amazon Web Services, the largest cloud provider on the planet, is just over 100 billion in annual revenue.
So they're getting one fifth essentially. Well, I mean, this is obviously 2030.
Amazon will be bigger in 2030.
Right.
But it's quite large, and I think CoreWeave's private projections before they went public were reaching around 20 billion before Crusoe. But for Crusoe being at 100 million last year, I think that's quite high revenue growth, and it'll be interesting to see who they find as customers to back up that 18 billion in the next couple of years.
Did you get the sense that there are customers that that would take Crusoe as their cloud provider?
Yeah, it's a good question. I think the most high profile customers that sources tell me are talking to Crusoe are more interested in the data center side of the business. So they want Crusoe to build them data centers quickly, and then they want to do the cloud part.
Okay.
But they have a couple years, and given an existing relationship through Oracle to OpenAI, I wouldn't be surprised if they're talking to some of the largest players like Meta, Google.
Last question for you before we go. I mean, 18 billion, we talked about the significant growth that would be an achievement that would be. Do you think they can get there?
It's a good question. I guess the thing I'll point to is the reporting that we've done on CoreWeave, and before they went public, they scaled back a lot of their private projections, and historically before they were public, weren't able to reach some of their rosy revenue projections. So my guess is that the same case would play out here, but we'll have to see.
That CoreWeave had trouble reaching their projections, and Crusoe may fall
potentially. I think given that this business is all reliant on building physical buildings and getting access to power, these companies are doing their best to project how many chips they'll get into those data centers. But it's a tough thing to calculate.
Great. Well, thank you so much for being here, Anissa. It was a fascinating story, and it is a fascinating company that I'm sure we're going to hear more about in the coming months. That is Anissa Gardizy, our cloud reporter here at The Information. Well, that does it for today's show. We want to thank you for joining us on The Information's TITV. A reminder, we are live every day at 1 p.m. Eastern, 10 a.m. Pacific. Before we go, I want to thank Amazon Web Services, who is our presenting sponsor for this production. We'll be back here on this stream tomorrow. Thank you so much for joining us.